Hello and welcome everyone. My name is Yasir and this is our first lecture of financial reporting. Today we will discuss learning outcome one, which is be able to prepare financial statement for sole traders and partnership. So let's get started. If there is any issue, concerns or questions, you can, press the, ask button over here. Chat, or you can ask me anytime. If you can't see my screen or can't hear my voice, then again you can let me know, or you can raise your voice and then I will sort the issue out. Okay, so unit aim to ensure that students have a sound understanding of the techniques of double entry accounting. After also completion of this unit, student will also be proficient in the use of double entry accounting techniques and the maintenance of accounting record. Also, develop the ability to identify and correct omissions and errors in accounting records and financial statements. If you guys knows about a bit of accounting, then it's rectification of errors as well. Also specify two components of financial statements and prepare and review non-complex accounts for a range of different business structures, including sole traders, partnership, and limited liability limited companies. You can check your knowledge. You can rate your current knowledge up to 10. So about sole traders and partnership. Indicative content, again, prepare a financial reporting statement for sole traders and partnership, for example, income statement, statement of financial positions, straight line method, depreciation of non-current assets, balance methods or irrecoverable debts or provision for doubtful debts or accruals and prepayments. Accounting process identifications, recording, classifications, measurements, reporting, and communication. Use of sole trader and partnership financial statement to shareholder, employee, potential investors, directors, managers, suppliers, customer lenders, government analysts. So any comments on this? Anyone can explain difference between sole traders, partnership, and limited liability? If anyone is there. Okay, so type of profit making entities. So there are three main types of profit making business entities: sole traders, partnership, and limited liability company. So sole traders operates a business independently, owning all assets and liabilities personally. So this entity may employ stock but retains sole traders. Sole traders. So sole responsibility for businesses, decisions, and risks. Just give me a second, guys. All right. So sole traders, sole responsibility for business decisions and risks. Sole traders benefit from direct control over operations and profits, yet assume unlimited personal liability for business debts. Partnership, on other hands, two or more people may go into business together. Uh, Partners share profit, losses, and responsibilities as per formal agreements. Then, limited liabilities companies are distinct legal entities owned by shareholders and managed by directors. This structure provides limited liability to shareholders, meaning their personal assets are protected in case of business insolvency. Limited liability companies enjoy a separate legal existence from their owners. Any questions so far, if anyone is there? Okay, so different type of organizations are not-for-profit entities and charities. Not-for-profit entities operates with the primary goal for serving public or social interests rather than maximizing profits. Examples include charities, clubs, societies, and non-government organizations. These entities are regulated under specific legal frameworks and adhere to accounting standards tailored to their unique operational and reporting requirements. Charities, for example, are subject to stringent regulations or overseen by bodies like the Charities Commission in the UK. They produce financial statements such as the statement of financial position and the statement of financial activities alongside an annual report to demonstrate accountability to shareholders. So these reports adhere to the statements, recommendation practices, ensuring transparency and proper stewardship of donated funds. So these are prepared in line with the statement of SORPs or statement of recommendation practices. So in other countries, requirements will be different. Limited liabilities companies, uh, limited liability companies offers distinct advantages and considerations as profit-making entities. They provide limited liability to shareholders, safeguarding personal assets from business liabilities. This features enhance investor confidence and facilitates investment by mitigating individuals' financial risk. Limited liability company can be structured as private or public entities, with private companies typically having fewer regulatory requirements compared to public ones. Compliance with national legislations and accounting standards, including international accounting standards, ensures uniformity and transparency in financial reporting across jurisdiction. Despite the benefit, establishing and maintaining an limited liability companies costs such as formation fee and ongoing compliance expenses. Owners known as shareholders or members elect directors to manage business operations on their behalf. Partnership is a business arrangement where two or more individuals come together to enjoy, operate a business, sharing both risk and rewards. The terms of their financial agreement are typically outlined in a formally document known as a partnership agreement if no such agreement exists. The default rules of the Partnership Act 1890 governs the partnership operations. In a partnership, profits are often shared equally among partners, and there are usually no salaries paid to partners, no interest on their capital contributions. But partners may receive 5% interest on loans extended to the partnerships. Partners also present inherent uh, uh, they basically partnership offers several advantages compared to single ownership like a sole traders and limited companies. They allow partners to spread a risk of sharing financial obligations and responsibilities. Partners also benefit from broader network of contacts which can facilitate business opportunities and growth. Uh, each partner brings unique skills, expertise, and expertise and expertise and client relationship which collectively adherence the business capabilities. Moreover, partners funds in it comparatively easier to raise finance due to combined assets and a shared ability, making them attractive for securing loans or investments. In contrast to limited companies, partnership enjoy flexibility as they are not required to comply with statutory obligations such as audit requirements or stringent accounting standards. This flexibility extends to the absence of uh, formation or registration fees, reducing initial overheads costs for the business. Uh, but partnership also present inherent disadvantages. Profit are divided among partners, potentially diluting individuals' earning compared to sole partnerships. Moreover, decision making can be complicated by multiple stakeholders, leading to dispute over management control and strategic direction. Importantly, partners are jointly liable for business debts and losses which can impact personal finances if the partnership encounters financial difficulties. Companies Act 2006, uh, this act established legal requirements that all registered companies in the UK adhere to central to this legislation to the obligation for directors to prepare annual accounts and have their approved by shareholders. The Act's main requirements are director must prepare and approval annual accounts and circulate them to shareholders. Account must be filed with the register of companies. Quoted companies must prepare and file international financial reporting accounts standards account. Other companies prepare either Companies Act accounting accounts following UK standards or IFRS accounts. Directors have a legal duty to keep adequate accounting record. Published accounts must show a true and fair view. Uh, Limited liability partnership. A key disadvantage of partnership is that the partners have unlimited liability. So limited liability try to solve this problem. This limited liability partnership try to solve this problem. So this is a separate legal entity, but it runs like a partnership. For example, LLP itself pays no tax, with partners called members being taxed as individuals instead. Uh, limited liability partnership do, however, have more in common with companies than the partnership. They are bound by the Companies Act 2006 and they must file accounts within company house. Okay. Right. Principle of double entry bookkeeping. Double entry bookkeeping is a foundation concept in accounting that ensures accurate recording of financial transactions. It operates on the principle that every transaction, affect at least two accounting with entries record on both the left-hand side debit and right-hand side credit of the ledgers. Uh, Debit entries denote increase in the expenses such as advertising cost or assets like new office equipment. For example, when a business incur advertising expenses or purchase new equipment, These transactions are recorded as debits because they increase expenses or add to the value of assets. Credit entries indicate decrease in liabilities, capital, or income. Uh, as you can see here, debit and credit increase in liabilities, expenses, debit, expenses, assets or drawings, and credit, liabilities, income, and capital. So assets increase with debit and decrease with credit. For example, purchasing office supplies can assets would increase this asset account with the debit entry. Liabilities increase with credit or decrease with debit. Uh, Decrease with debit when a business pays off a supplier, reducing liabilities, it records a debit to the liability account. Income revenue increase with credit and decrease with debit. Expense increase with debit and decrease with credit. Equity capital or capital increase with credit and decrease with debits. When an owner invests additional funds, increasing equity, it's recorded as a credit. So by applying these principles consistently, business maintain accurate financial records that support informed decision-making, financial reporting, and compliance with accounting standards. Any questions so far, if anyone is there? Right. What is depreciation? Any question? Anyone can explain what is depreciation, if anyone is there? Okay, depreciation basically is an accounting method used to allocate the cost of a non-current assets over its useful life. It reflects the gradual consumptions or expiration of an asset, economic benefits as it is used its business operations. The carrying amount of asset is original cost less accumulated depreciation. This reflects the portion of the asset costs that has not yet been expensed. So entries for depreciation are recorded in the statement of profit and loss count, debit statement of financial positions, credit depreciation charge for the year, statement of profit loss, and in credit statement of financial positions accumulated depreciation. So there are used to calculate depreciation charge on a NCA straight three main methods: straight line methods, dimensioning balance method, units, or production methods. So methods for depreciation: straight line method. This method evenly spreads the depreciation expense over the asset's useful life. The formula for straight line depreciation is here the cost of the asset is divided by the number of year it is expected to be used, resulting in consistent annual depreciation charge. A dimensioning balance method, known as also reducing balance method, calculate depreciation based on a fixed percentage of the asset's book value. Then finally is units of production methods, allocates depreciation based on the actual usage or output of the assets rather than time. The formula calculate depreciation per units of output, which is then multiplied by the number of units produced or used during the accounting period. So this method basically is suitable for assets like machinery or vehicles whose wear and tears correlates directly with production levels. Now, errors in the trial balance. There are three main types of no. There are different types of errors. First of all, is omission. Both sides of transactions completely left out original entry. This occurs when a transaction is completely left out of the accounting records. For example, uh, yeah, original entry. This involves reducing incorrect debit and credit amounts, but applying them incorrectly. For example, a credit sale of £1,000 might be recorded as a debit for the sale ledger, control account, and credit or sales for 150 each instead of the correct £1,000 credit to sales. Reversal of entries. The transactions amount is correct here. The transaction amount is correct, but the debit and credit entries are reversed. For example, recording a 500 repair expenses as a debit to motor vehicle at cost and a credit to bank, instead of debiting repair and expenses and crediting bank. Error of principle. This type of error involves recording a transactions correctly uh, in terms of amount and accounts, but in the wrong category. For example, recording £500 spent on repairing a method vehicle as a debit to a motor vehicle at cost and non-current assets instead of repairs. So these errors impact the accuracy of financial reporting and must be identified and corrected to ensure that trial balance accurately reflects the financial position of the business. Any question if anyone is there? Okay, so error of commissions. This occurs when a transactions is recorded correctly but in the wrong accounting account with the same category. For example, recording £200 spent on telephones cost as a debit to insurance expense instead of telephone expenses. Entry duplicate on one side, nothing on the other. When a transaction is accidentally recorded twice on one side, either debit or credit, and not at all on the other side. For example, recording £300 credit sale as a debit to sales ledger control account and also as a debit to sale. So without a corresponding credit entry. Balance incorrectly transferred. This error happens when the balance of a nominal ledger account is incorrectly transferred to the trial balance. For example, uh, uh, a sale account with a balance of 560 might be recorded in the trial balance as 650 or £400, leading to discrepancies in the final trial balance totals. Right. Types of anyone can see my screen? No issues about voice if anyone is there? Okay, accounting types of tasks. Accounting tasks often vary in complexity and require specific competencies to address various scenarios. Tasks involves incomplete record, present challenges that requires proficiency in several areas. like prepare of accounts from information in the task, dealing with theft or cash, theft or destructions of inventory, dealing with estimated figures, like in case where precise figures are unavailable, estimated amounts may be used. For example, if drawings are stated to be between 15 and 20 pound per week, accountants must apply the appropriate figures within the range to calculate net assets accurately. Calculations of capital and profit. Accountants calculate capital by determining net assets, which involves subtracting liabilities from assets. Profit is calculated using the formula profit is equal to increase in net asset plus drawing minus increase in capital. Any questions so far? Okay, VAT or sales tax, value added tax. Value added tax is consumption tax charged on most goods and services at a standard rate of 20%. In the UK, so in the UK, VAT applies to sales made by businesses, output tax and VAT incurred on purchase and expenses input tax. Output tax refers to the VAT charged by businesses on their sales transactions. It is calculated based on the selling price of goods or services and must be collected and reported to HM, Revenue and Customs. Input tax, VAT, is the VAT incurred by businesses on their purchases of goods and services. Uh, this includes VAT paid on purchases and expenses related to business operations. Then VAT returns. Businesses calculate their VAT liability by subtracting input VAT tax, VAT paid on purchases from input output tax, VAT collected on sales. If output tax exceeds input tax, the excess must be paid to HMRC quarterly. Price to customers. Prices can be quoted to customers either inclusive or exclusive of VAT. Inclusive pricing include VAT in the total price, while exclusive pricing adds VAT on top of the quoted price. Deriving missing figures from incomplete information. In incomplete record scenarios, driving missing figures requires specific methodologies, particularly concerning credit sales and receivables. Formulate formula linking sales, cash receipts, and receivables. So the relationship between opening receivable sales and cash receipts is crucial. The formula uh, ensures that the sum of opening receivables, sales made, and cash receipts received equals the closing receivable balance. Control account method. Uh, Utilizing a sales ledger, control account aids in calculating missing figures. This account summarizes transactions related to sales, cash receipts, and receivable, enabling reconciliation and determination of the required figures. Uh, deriving missing figures from incomplete informations. Formula for linking purchases, cash payment, and payable accountants, are a formula that connects opening payable purchases, made cash payments, disbursed, and closing payable. So these calculations ensures consistency and accuracy in reporting these financial elements. Utilizing of purchase ledger control account, the purchase ledger control account consolidate transactions related to purchase, cash payments, and payables. This centralized approach aids in reconciling data and deriving missing figures effectively. Accurate determinations of these figures is important for maintaining financial integrity, compliance with accounting standards, and supporting informed decisions making with businesses. Uh, Gross margins and markups. Gross profit represent the difference between sales and the cost of goods sold. It can be expressed either as a percentage of the cost of sales or as a percentage of sales. Percentage of cost of sale, it gross profit, it stated as 25% of cost of sale. This implies a mark up on cost. For example, it cost of sale is 80 pound, then gross profit would be 20 pound. So percentage of sales, it if gross profit is expressed on as 20% of sale, then indicates a gross margin or profit percentage on sale. It sales amount to 100 pound, then profit, a gross profit would be 20 pound. Calculating cost of sales. Cost of sale is computed by adding opening inventory to net purchases and subtracting closing inventory. So this figure is essential for accurately determining gross profit and overall profitability. Stolen or destroyed goods. Another challenge is in incomplete record involves calculating the cost of goods stolen or destroyed, which impacts the calculation of cost of sales and overall profitability. So cost of gross sold based on gross profit margin or marks up, uh, calculating the uh, calculating the difference. So by comparing basically the cost of goods sold, calculate using standard formula opening inventory plus net purchases minus closing inventory with the actual goods sold. Accountants can identify discrepancies that suggest lost or stolen goods. Then finally, impact of on financial statements. Discrepancies between expected and actual inventory levels due to theft or loss affect the accuracy or financial statements. It is important to reconcile these figures to ensure that reported profit and inventory values are reliable. Addressing these challenges requires careful analysis and application of accounting principles to ensure accurate financial reporting and compliance with regulatory standards. Cash book, incomplete record often arise in small retail businesses where transactions are primarily conducted in cash. The cash book, particularly the three-column cash book, uh, uh, plays a vital role, important role in preparing financial statements. So components of the cash books are, bank column record transaction involving the business's bank account, including checks drawn and received. Cash column records transactions such as till receipts, expenses paid from the cash before banking and drawing, then discount column, then record receipts and payments, and then finally reconciling cash and bank balances. Regular reconciliation of cash and bank balance ensures accuracy in financial reporting and identification of any discrepancies that requires further investigations. Any questions or any concerns so far? Okay, so accounting or movement between cash and bank accounts involves recording contra entries to maintain accurate financial records. So key points includes contra entries explanations. Contra entries are transactions that involves both the cash column representing cash transaction and the bank column representing bank transactions. So typically these entries involves cash receipts are lodged in the bank debit bank column and credit cash column, or withdrawals or cash column and bank to top up the till. So debit column, cash column, credit bank column. Recording unknown figures in case of incomplete records, accountants face challenges where certain figures are unknown and need to be derived. This involves crediting the cash columns or for known payments from till receipts, for example, expenses, drawing lodgement into bank. Uh, Importance of accuracy. Accurate recording of contra entries ensures that cash and bank balances reflect accurate actual transactions, supporting financial transparency and decisions making within the business. Understanding these concepts is essential. Recording, reconciling cash and bank transactions effectively and addressing, challenges uh, posed by incomplete financial record. Any questions so far? Okay, so accounting equations. Accounting equations forms the foundation of financial reporting, balancing assets, liabilities, and owners' equity. Key points include accounting equations explanations. The fundamental accounting equation is account assets is equal to liabilities plus owners' equity. So this equation illustrates the balance between what the business owns, assets own. Uh, Liabilities and the owner's investment equity. Drawings drawings refer to withdrawals made by the owners for personal use, which reduce the owner's equity. In the business examples include owner deposit personal money into business bank account, uh, debit bank credit drawings, owner pays personal expenses from the business bank account or till debit drawing credit bank cash. A wording of an assessment uh, tasks drawing involves determining the amount withdrawal by the owner from the business. For example, if drawings are approximately £40 per week over a year, the annual total would be 40 multiplied by 52, as you can see here. 2080 pound when drawing range between 35 and 45 pound per week. The specific figures needs to be calculated based on available information. Understanding the implications of drawing and their impact on the accounting equations helps maintain accurate record and financial reporting integrity. Any questions so far? Goods drawn by a proprietor and accrual repayments. In accounting, understanding how to handle goods drawn by the proprietors and managing accruals and prepayments are important for accrual, financial reporting, and decision making. So, basically, accruals and prepayments are accounting adjustments made to ensure that expenses and revenues are recognized in the correct accounting period, irrespective of when cash transactions occurs. Any questions so far? Financial statements. In financial accounting, the statements of profit or loss, also known as the income statement, is a key financial documents that summarize the revenues, uh, expenses, and resulting profit of loss for a specific periods. So, statement of profit and loss components: income, sale revenue, less discount receipts, then expenses, cost of goods sold, other operating expenses, gross profit, and then finally we get net profit. So implications of the statement of profit or loss financial performance, it provides a snapshot of how well the business has performed in terms of generating revenue and managing expenses during the period. Decision making stakeholders and the statements to assess the profitability and financial health of the business, adding in decision making process. Comparison, year to year comparison of profit or loss helps in evaluating the business growth and identifying trends in financial performance. Understanding these components allows business to monitor their financial performance effectively and make informed decisions to improve profitability and sustainability. Statement of financial position. The statement of financial position, also known as the balance sheet, previously known as, now it's been few years they have changed the name. So basically financial position, but still also known as the balance sheet, presents the financial position of a business in a specific point of in time. It outlines the assets, liabilities, and equity of the business, providing a clear, picture of its financial health. So, components of the statements of financial position: assets, non-current assets, current assets, liabilities. Non-current liabilities, long-term obligations that are not due within the next accounting period, such as bank loans. Current liabilities, short-term obligations due to within the next accounting period, equity, capital introduced, profit, drawings, implications of the statement of financial positions. It indicates the solvency and liquidity of the business by showing the relationship between assets and liabilities. Investment decisions, or investors are use the balance sheet to assess the financial health and risk profit of the business before making investment decisions. So finally, regulatory compliance: business must prepare the statement of financial position in accordance with accounting standards and regulations to ensure transparency and compliance. Any questions so far? So financial statements of financial position as the end of the period: non-current assets, current assets, non-current liabilities, net current liabilities, credit, non-current liabilities, credit, net assets here, and then capitals. So basically calculating as total assets minus total liabilities, including the residual value of assets that would be left over if all liabilities were settled. This financial, position provides a snapshot of the financial health and stability of the business at a specific point in time. In financial accounting, the preparation of financial statements involves several steps to ensure accuracy and compliance with accounting standards. Uh, Initial trial balance and adjustments, extended trial balance. This involves also, preparing financial statements, statement of profit and loss, statement of financial position, which is also known as balance sheet, challenges and consideration. Understanding the correct format for each financial statement is important to ensure compliance with accounting standards and regulatory requirement. Cost of goods sold and inventory in the trial balance. Uh, the management of inventory and cost of goods sold uh, is important in financial reporting, affecting both the statement of financial position and the statement of profit or loss. Inventory in financial statement, inventory is classified as current asset and represents goods held for sale. Components including opening inventory, purchases, net of returns, and closing inventory, which are important for determining the inventory balance on the balance sheet. Proper management of inventory and accurate calculation of cost of goods sold directly impact the profitability and financial health of the business. Errors in inventory valuation can lead to misstatements in financial statements, affecting decision making and financial analysis. So understanding the intricacies of inventory management and cost of goods sold calculation ensures businesses can report their financial performance accurately and meet regulatory requirement. Next is a partnership agreement. A partnership is an arrangement where two or more individuals, collaborate to operate a business, sharing risks, responsibilities, and rewards. So, key aspects of partnership agreements: formation and legal framework, financial agreement arrangements. Partners agreement specify important financial details, including capital contribution by each partners. Importance of partnership agreement, clarity and governance. A well-drafted partnership agreement clarifies the rights and responsibility of each partner. Partners must adhere to the terms set out in their agreement and comply with with legal requirements to ensure transparency and accountability. Flexibility and adaptability. Partners agreement can be customized to suit the unique needs and circumstances of the partners and the business, allowing for flexibility in management and operational decisions. So understanding partnership agreement is essential for partners to establish a legally compliant business structures, fostering trust and collaboration while ensuring financial stability and growth. Accounting for partnership, statement of profit and loss. Uh, A statement of of loss in partnership mirrors that of a sole trader, but an additional steps of appropriations among partners. Statement of profit or loss In sole trader scenario, the statement of profit or loss outlines the financial performance of the individual's business owners, which include sale, cost of goods sold, gross profit, less expenses. Then, but partnership considerations, sales and cost of goods sold, gross profit, less expenses, profit appropriations. So the important difference lies in profit appropriation, where the partner's profit is allocated among partners according to the terms of the partnership agreement. Sole trader, the entire profits belong to the sole traders. Accounting of partnership profit appropriations account. Again, steps: allocate the partner's salaries, allocate any interest on capital, any commissions earned by partners, changes any interest on drawings, or allocate remaining profit balance in profit sharing ratio. Accounting for partnership profit appropriations, accounting again continue. In the context of a partnership, the profit appropriations account provides a structured approach to distributing profits among partners based on their contributions and entitlements. The total profit earned by the partners during the period's salaries, fixed amount allocated to each partners as compensation of their role within the partnership. Uh, if you see, for example, ABC, partner A receives 4,000, B receives deductions 25, and C receives a total of 4,500. So interest on capital, returns paid to partners based on their capital contribution to the partnership, sales commissions, earning distribution to partners based on sales performance or other specific achievements, and purpose and significance. The profit appropriations account serves to transparency, a partnership, allocate partnership profit among partners, ensuring each partner receives their due share as per the partnership agreement. So by dealing these allocations, the account reinforces financial accountability and partnership cohesion. Next is residual profit available for distributions. Again, partners receive a portion of the residual profit according to their profit sharing into stipulated in the partnership agreement. Partner A get 40%, 7,120. B get 20%, which is 7,800. Uh, and then receive 33,560, and then C receives 40%, which is 700 and 7,120 pounds. So the profit share is always the last entries, splitting the residual profit after all other allocations. Statement of financial position again. Statement of financial position for a partnership outline the financial standing of the business of a specific point in the time. It differs from that of a sole traders by incorporating multiple capital accounts representing each partner's investment and interest in the partnership. So the key components: proprietors or sole traders interest, uh, uh, reflecting the owner's capital and accumulated profit. In partnership, the statement of financial positions include a capital account of partner A and partner B, and accounts on it is also accounts for any amount owned by partners in the business, typically reflecting loans or advances made by partners to the partnership. Capital accounts. Capital accounts in partnership serves as detailed records of each partner financial transactions and interest within the business. These accounts tracks day-to-day activities such as profit allocations, drawings and interest on capital. So when a partners yeah, so when a partners joins admission of a new partner. When a new partner joins a partnership, several accounting adjustments are necessary to accommodate the change in ownership and profit sharing structure. The process involves updating profit allocations, adjusting capital accounts, and ensuring a smooth transaction for all partners involved. So after initial adjustments for profit allocations and capital accounts, further steps are taken to finalize the transition and ensures all financial aspects of the partnership are updated and accurately reflected. So as you can see that balance of the capital account, post changes profit, appropriate remainder of profit using new partnership agreement, re-salary, interest, and profit shares, put drawing through the current accounts, prepare the statement of financial position if required to do so. Retirement of partners. When a partner retires from partnership, it requires careful financial adjustment to ensure a smooth transition and to settle the retiring partner's financial interest in the business. The process involves updating profit allocations, adjusting capital accounts, and ensuring the retirement does not disrupt the partnership's financial stability. So the retirement of a partner necessitates systematic financial adjustments to accurately reflects the retiring partner's entitlements uh, and to maintain the financial integrity of the partnership. So these steps ensures that the retiring partner financial interests are properly settled while uh, preserving the partnership's operational continuity. Changes of the partnership or retirement and existing partner. Uh, After addressing initial adjustment for profit allocations and current account balance, further steps are taken to finalize the retirement process and ensure the financial aspect related to the retiring partners are appropriately managed. Uh, Determine the retiring partner's final capital balance based on the closure of their current accounts and the any adjustments required as per the partnership agreement or task instructions. Depending on the task instructions, settle the retiring partner's final balance by either paying in cash, debiting capital account and crediting cash account. So, or creating a loan account, debiting capital account and debiting capital account and credit loan accounts. So allocate the retirement profit using the new partners agreement, adjusting the changes in profit sharing ratios resulting from the retirement. Uh, uh, if required, update the settlement of financial position to reflect the retirement of the partners. including adjustments in capital accounts, liabilities, and assets. So this step ensures that the financial position of the partnership accurately reflects the current ownership structure and financial obligations. Changes of to the partners' goodwill, understanding goodwill in partnership changes. Uh, we significant changes occur in partnerships such as the retirement of admission of partner. It often necessitates a valuation of the business. Goodwill represent the intangible value of a business owner and above its tangible assets and liabilities. It reflects factors like reputations, outcomes, uh, customers like reputations, customer based and operational synergies that account contribute to the business overall value. Calculation and examples: for example, consider a partnership where the business has a book value of 220,000 pounds based on its assets and liabilities. Upon valuation as a whole, the partnership is deemed to be worth 350,000 pounds. This 130,000 pound differences is attributed to goodwill, with 80,000 pound linked to an increased property value and 50,000 pound to the business, regional and customer base. Goodwill is important in determining the fair value of a partnership, especially during changes such as retirement, a new admission. It represents the premium a buyer would pay for the business due to the its established customer relationship and reputation. Changes to the partnership goodwill again. Uh, Goodwill, being a subjective and intangible assets, plays a critical role in partnership adjustments where changes occur, such as the retirement of a partner or admission of a new partner's. Goodwill must be accounted for in a way that reflects its impact on the partnership financial positions. Accounting treatment goodwill. Initially, goodwill is addressed to the partner's capital accounts based on the existing profit sharing ratio. This step ensures that the increase in partnership value due to goodwill is recognized in each partner's capital balance proportionally. For example, goodwill is 50,000 pound capital accounts using existing PSR profit sharing ratio. Then debit goodwill will be a debit 50,000 and credit capital account credit 50,000. Despite being added initially, goodwill is not retained as an asset on the partnership statement of financial position. Instead, it is removed using the new profit sharing ratio or to reflect the adjusted partnership value without goodwill. For example, calculate account using new PSR profit sharing ratio, debit capital account 50,000 and credit goodwill account 50,000. That's it for today, guys. Thank you very much. Here's some website for further readings, and you can get some books on your learning management system or Moodle. Thank you very much for joining me today. This was our first lecture, and if you have any issues, concerns, or questions, you can drop me an email at yasir@ukversity.co.uk. And so for our next session, I'll see you tomorrow, same time, 2 o'clock. And thank you very much, everyone. And bye till tomorrow at 2 o'clock. So bye, everyone, and have a good evening.